Hey guys. Okay, so this is going to be a hopefully not terribly long stream about fractional reserve banking. I have the setup slightly different. As you can see, I wanted to be able to write some stuff on the board, so I've got the whiteboard up. Consequently, I'm holding my mic rather than it sitting on my table. So if the sound is terrible, let me know and I'll see what I can do about it. But yeah, it's going to be worse than normal. Anyway. Fractional reserve banking, for those who don't know, is the idea that the bank has to hold in reserve a fraction of the amount that it lends out. So I'm going to give you an example here, and I'm going to follow AA's kind of general, the way he does when he does videos and talks using names. So it's going to be a little strange just because this is all going to be in American dollars. And by the way, when I'm streaming, the Hangout shows me an image, and it's always a mirror image. When the video goes up, it shows it correctly. But if I start writing and it looks like I'm writing in reverse, please let me know. And I don't know I don't know how I'm going to fix it, but hopefully even on the stream, it's not reversed for you guys. Anyway, this is all going to be in dollars, like I said. Now, sorry. I'm going to have to figure out how to do this without putting the mic in front of the camera. Okay. AA has $1,000. AA decides that he's going to, and yeah, I know this doesn't make sense because it's in dollars and half of the people I'm going to use are going to be non-Americans. Anyway, AA puts his money in the bank because he doesn't need it right now. He figures I'm going to invest it, or not even invest it. I just want it to be safe because nowadays, I don't know how it is in England, but at least in America, you get pretty low interest rates on your investments, at least in general savings accounts. But he just puts it there to keep it safe because he doesn't want to keep it, under his mattress or something where it could get stolen. So the bank has now $1,000 that it's holding for AA. The general understanding I've heard so many people think is fractional reserve banking. We're going to assume a 10% here. Hopefully you can see that there. We're going to assume 10% is the legal reserve in this scenario. So many people interpret it this way. They say, okay, that means you have to keep 10% in reserve of whatever you lend out. The bank has $1,000, therefore it can lend out $9,000 because it only has to keep 10%, or in this case, it would be, it only has to have 10% of whatever the total is. So 1,000 plus 9,000 is 10,000. So there we go. Sorry, I'm just glancing at the chat real quick. Okay, nobody's saying it's backwards, so I'm assuming it's not backwards for you. When I look at it on the computer, it's backwards for me. So I'm just going to look at the whiteboard. This is just how so many people seem to understand it. And this is even how AA presented it in his stream. He says, if I put $1,000 in the bank, then the bank can lend out $3,000. The problem is banks don't print money. In the US, the Federal Reserve prints money, yes. But they don't just print money. The bank can't go to the Federal Reserve and say, hey, AA just deposited $1,000, give us $9,000. That's not how it works. The bank cannot lend out more than what it has, legally or just in reality. It doesn't just make money out of thin air. And this is something that so many people don't seem to get. So, yeah. Oh, somebody in the chat is correcting me. So Sailor says, no, it's 900, not 9,000. Exactly. Yes, that's correct. The bank can lend out 900 because it has to hold in reserve 10%. And yet, for some reason, people think they can lend out more than what they have. And it's just, I don't know. I actually do know where they get this idea from. And I'm going to go through the long form, the explanation, going down the chain a bit of a ways to explain where people get the idea that if they're holding 1,000, they can lend out 9,000, and to explain why that's nonsense. So the bank has $1,000 now that technically belongs to AA, but the bank is holding it. So they lend this out to, and I'm just going to use it. They lend it out to, actually, I wasn't going to use it him. Hold on. They lend $900 to Mark. Because Mark has seen how the Britishers' tea shop went. It was a big success. So Mark wants to start up a tea shop. So he borrows $10,000 and he spends it. He pays it to the Britisher in order to get supplies and whatnot. Maybe he's going to buy one of the branches of the Britishers' tea shop. So now Mark has borrowed $900, paid it to the Britisher in order to start his own tea shop. The Britisher takes that $900 and puts it into his bank. He has bank 2. So bank 2 now has $900. Bank 2 also has to hold in reserve 10%, $90, so that Bank 2 can lend out, anyway, $810. So Bank 2 gives lends $802 to Bond 2. Bond 2 takes that and goes ahead and spends it, gives Liz $810 to do his bookkeeping because he's got a business that he wants to run his business. He's a good salesman. He's not a good bookkeeper. So he pays Liz to do the bookkeeping. And now I can see on the stream, the text is getting very, very small. Hopefully you can still see it. And Liz puts that into her bank, which is going off the screen. But, oh, sorry. Bank 3, $810. Yeah, we can't quite see that. There we go. I've got other writing on the board that I use this for work, so I don't want to go too far in either direction. I just erased a big section of it here in the middle. Anyway, again, I'm sure this is very small on your screen if you're not watching it full screen, so it may be difficult to read. But basically, here's the start. AA has $1,000. He puts it in the bank. The bank lends $900 to Mark. Mark pays that to the Britisher, and the Britisher puts that into his bank. Bank 2 now has $900, in which they lend $810 to Bond 2. He pays that to Liz, and Liz puts it into her bank. So you can see here, a lot of people are going to say, oh, this is artificially inflating the money supply, because now rather than just having $1,000, we have 1,000 plus 900 plus 810. So it's just, you can see it's like, oh, we've got more money and more money and more money and more money and more money. So now, wait a second, not all of that money actually exists. So what's going on here? It looks like we actually have more money than is in existence. This is where people get the idea of fractional reserve banking artificially inflates the money supply, because it makes it look like there's more money out there than there really is. The problem is something they're not taking into account is debt, liabilities. Mark owes the bank $990 because he borrowed this at 10% interest. Bond 2 owes the bank $891 because he borrowed it at 10% interest. The bank 2 owes Britisher $900 in total, because we're assuming he's just putting it into a checking account. He's not getting interest back. And Bank 3 owes Liz $810 because, again, she's just putting it into a checking account. Liz and Britisher have businesses. We're not investing at interest. We're just putting it into a checking account. AA is the only one that's going to get it back with interest, and he gets maybe 1% interest. So the Bank 1 owes AA $110. So AA is going to make $10 off of his transaction. Bank 1 is going to make $90 off of theirs. Bank 2 is going to make $81 off of theirs. And basically nobody else made money in this, although there was value added. If you say that Mark obtained the tea shop from the Britisher, and Liz, Liz just got money because she gave services to Bond 2. She didn't give something. So Bond 2 got services from Liz's business, we'll just say. Anyway, when you take into account this, the liabilities, there is no increase in the money supply, because when you lend money, you're not creating new money. You are increasing the assets and the liability of the other person or the entity. Now, I need some more space here. I think I'm just gonna do this, and if I can move the light, not very easily. One sec. Okay, just turning off one light, so it's going to get dark there for a minute. But I'm going to give you an example here that will relate to this, so I don't want to erase everything yet. It's going to seem very different, but just bear with it for a minute. So Liz has a business, and I'm just using my business as an example, which, actually, hold on, I'm going to change this example. The business I have, I started on my own, but then at one point I actually bought a block of business from someone else who does the same thing I do, but she wanted to retire. So I'm actually going to, I'm going to call her Sarah. Her name was not Sarah, but I'm just using Sarah because I haven't used her yet. So Sarah had a business, And she's ready to retire. She wants to sell it. Liz wants to buy the business, so they need to determine how much the business is worth. In my line of business, because it's a service industry, what we do is we usually take the gross the gross receipts for 1 year, and that's what we just determined. Okay, that's the purchase price. So the business made $60,000 last year in gross receipts. That was not net profit. That's the amount of money that was brought in before expenses. So that's what I'm going to pay, $60,000. Sarah says, plus the value of the net assets. So let's say the business is worth $60,000, but then 60,000. But then you also have to add in the net assets. That would be cash in the bank, value of furniture, machinery and equipment, things like that. What else am I getting in addition to just the block of business? Sarah realizes, okay, I've got $10,000 in the bank. So the business as is worth $70,000. And Sarah says, well, you know, I'd like to have more than that. I'm going to take out a loan for $100,000. So now my business is worth $170,000, right? Hopefully most people will realize, no, it doesn't work like that. Why? Assuming she took out the loan as the business, and I'm just realizing that red is supposed to represent debt and the black is supposed to represent assets, so I did that backwards. But if she takes out a loan as the business, she has the assets over here. So she has now $110,000 in cash, but she has also a liability of $100,000. So when looking at the net assets, you have to subtract the liabilities from the assets. She only has net assets of $10,000. It's kind of like if you buy a house, you buy a $200,000 house and you pay 10% down. What are your net assets? Your net assets are $20,000. Or hold on, yeah, 10% down. Your net assets, you don't have assets of you have gross assets of $200,000 because you have a $200,000 house. You have net assets of $20,000 because you have a $180,000 loan. You can't just say, oh, here are my gross assets. Here's the money I actually have. I'm going to ignore all the debt. If you're looking at how profitable a business is and you see, oh, wow, look at this. They brought in $1 million last year. That's awesome. And then you realize, but they had expenses of $2 million. When you look only at the positive and just say, we're just going to ignore all the negative, then yeah, it seems like, whoa, this is a lot of money. Oh my goodness, we're creating money here. But we're not. We are exchanging money for debt. It's kind of like buying a service it is like buying a service. It's not like buying a good because there is nothing physical, but excuse me. Sorry, hopefully that mic didn't pick that up too much. Anyway, in this whole scenario going down the line here, we are exchanging, the bank is exchanging money for debt. The individuals are exchanging money for debt. Now, in some cases, they're exchanging money for services or money for goods, but ultimately it is tied to the debt. So when you take out the debt portions of this, you still just have the $1,000 left. Fractional reserve banking does not artificially inflate the money supply. It's the same as a business saying, if we invest $100,000 into advertising, we're planning to get $100,000 in returns. So that would be actually a net zero. So why would you do it? Unless you just wanted to make the business look like it was more profitable because you're just saying, oh, here, we had net receipts of $100,000. Not saying we had net expenses also, or sorry, we had gross receipts of $100,000. Not saying we had gross expenses of $100,000 also. Again, when you just look at the black, yeah, it does look like it's artificially inflating the money supply when you ignore the red. Where it gets a little complicated is when you add in the regulations where the government is trying to tell the banks, you have to lend to people who can't pay it back. That becomes a problem. That's when banks start charging much higher interest rates. Why do they charge interest? Some of it's to make a profit. Some of it's to cover when people can't pay. Because they're not going to just lend out $900 here. They're going to lend out 1,000 loans like this. And some of them aren't going to come back. So the interest on the ones that do come back is going to cover the ones that don't come back. That's it. The fractional reserve is not a way of increasing the money supply. It's actually a way of saying banks are not allowed to lend out more than what they have. Now, one sec, I'm going to turn the light back on. So poor Sarah, we lost her business. I can't move the whiteboard because it's attached to the wall. Anyway, a lot of people want to say, oh, but this is wrong. This is just, I think most people who say it's wrong are saying it because they don't understand it. But just take out banks here and replace them with individuals. Let's say that AA is an individual. He has $1,000. He really doesn't want to hold that $1,000 in his home. So he goes over to, now I'm going to use somebody from the chat. This is not McCarthy, the historical individual. It's McCarthy from chat. McCarthy has a security firm, and he says, I can keep your money safe. I'm going to put it in a safe. And yeah, just make sure that nobody steals it. And AA says, awesome. So he gives it to McCarthy. Now, McCarthy's not going to pay it back with interest. In fact, in this case, AA would probably have to pay him. Mark needs $900. McCarthy, as an individual, has this business. He's got all this money, and the $1,000 is just a piece of all the money that he has in his business. Mark is a friend of his, and Mark says, dude, I need $900 because I want to buy a new business. I'm going to pay you back with interest within 6 months. Well, McCarthy knows AA is going to leave it there for a while because AA has already said, look, this is for my retirement. I'm not going to want it for 40 years because I'm still a young guy. So McCarthy says, okay, sure. I'm going to lend you $900. You're going to have to pay me back within 6 months. This is important. Should he be allowed to do that as an individual? People who want to say banks shouldn't be able to do this, you'd have to say individuals shouldn't be able to lend money to people. In which case, AA couldn't give the money to McCarthy in the first place because he is essentially lending it to him. Now, you could go with the argument of, okay, you can only lend that which you own because McCarthy doesn't technically own it. He's borrowing it from AA. He hasn't. So that's one argument you can make. But are you really going to say individuals can't? Yeah. But okay, I could get into that, but I realize that's going to just get into something a lot more complicated. I would like to ask the chat, is this making sense? Do you have questions, any specific questions you'd like me to address? I know I went over a lot of stuff fairly quickly, so I'm good at multitasking when I'm working. I'm not good at multitasking when, there we go. Not always good at multitasking when I'm streaming, but I'm just gonna look over this real quick. Yeah, see, it looks like most people who are watching actually understand this, and they're like, yeah, this is how it works, exactly. I can't understand how, okay. I don't know who Doppender is. I thought Doppender killed Bantu, Steven says. No, Bantu he's just a guest on AA streams, so I don't know who that is. If Bantu's dead, I haven't heard about it yet. Yeah, the Federal Reserve is a separate issue. I have major problems with the Federal Reserve, and that could be a complete stream in and of itself. Oh my goodness, anyway. I do have major problems with that, but I don't think that people should mix up the Federal Reserve with individual banks. And yes, a lot of banks have problems too. I have problems with a lot of banks, but that's separate. Banks in general, banks as a concept, I don't have a problem with that. I have problems with certain banks. Okay, so Silly Sailor is talking about inflation here. Yeah, inflation is not... I'm not sure I agree with what you're saying there. I need to think about it for a minute. Explain how is it debited and credited in transaction. Zachary says, explain assets is equal to liabilities plus equity. I was trying to explain it in very simple terms. I could show you a balance sheet. I could show, okay, so I can do that too. All right. So if you haven't, you can either screen cap this or screenshot this, or just pop in the camera here. Go back and watch the stream later. I'm going to erase this for a minute just to, yeah, so I'll explain assets, liabilities, and equity. This is not so much to do with, or not directly related to the fractional reserve banking. Well, I mean, it is. But here, bookkeeping 101. I think most people who have been watching my stream who know much about me know that I'm a bookkeeper. That is my profession. So I'm going to explain very briefly a balance sheet. When you have a balance sheet, explain how value is added. Value added, see, that gets very complicated. It depends on what you're talking about. Are you talking about, I mean, if you're talking about just money, interest is basically the only thing you're going to have there. So we're not going to go into that too much. But yeah, fully understand what you're saying. I don't see how this isn't inflating the money supply. You spent $9,000 when there only exists $1,000. The effect is the same. Actually, no. You think about it like this. Okay, sorry. Let me read that out so that people people who aren't reading the chat can hear. Excuse me. It says, I understand what you're saying, but I don't see how this isn't inflating the money supply. As you have just said, you spent $9,000 when only $1,000 exists. The effect is the same. Okay. I'm going to give you a different example. Again, taking it out of the bank scenario. Dad has 100,000. Somebody's dad, not my dad. I'm sorry, 1,000. Dad lends it to his son. He said because the son wants to. Trying to think how what we would do in this case, because I don't want. He's not going on a business. He decides he's going to go on a trip. The son just wants to go on a trip before he starts his job. He's starting a job shortly, so he's going to be able to pay his dad back. He just hasn't done it yet. So the son takes $1,000 and gives it to, in this case, who's somebody I could use. I don't know who I can use. I'm just going to say Bob, because I don't know. Bob's a travel agent. I can't think of somebody on the streams that I can use as a travel agent. Anyway, so Bob has $1,000 now that the son paid him. Bob gives that money to, so Bob got this from his business. Bob gives that money to his daughter, who also just graduated near the same time, and she also wants to go on a trip, except that in her case, okay, she doesn't want to go on a trip. She wants to get professional photos done just for her graduation or something. So she hires a photographer. She hires Stephen. She gives him $1,000, to do these photos. And then Stephen puts his money in the bank. Or rather, no, I'm going to change that. He gives his money to the bank, but what it is he's actually making a payment on his house. So now the bank has $1,000 that's theirs. So he's actually paying that to the bank because he bought a house from the bank. He owed money. And now, in this case, now are we looking at this? Was money created along the way? There were no banks involved until the very end. And even there, that's money that belongs to the bank because Stephen owed the bank. Dad lent his son the money and the son paid it to Bob. This is now Bob's money. Bob gives it to his daughter as a gift. This is now his daughter's money. Daughter gives it to Stephen, because Stephen didn't perform the service. This is now Stephen's money. Stephen gives it to the bank because he owes the bank. So now it's the bank's money. Was money created? And no, the money was not created. It's money exchanged hands, but it was not created. If we check this out and say Bob lent it to his daughter, so now the daughter owes money back to Bob, son owes money back to his father, then dad still owns $1,000 that son's going to pay him back. Bob owns $1,000 the daughter's going to pay him, and the bank owns $1,000 that Stephen just paid him. Has money been created? No, money has not been created. Debt has been created. Money has not changed. This $1,000 is currently the only $1,000 that actually exists. Stephen has already let go of it. He doesn't own it. He doesn't owe anybody anything, except if he owes more on his house. But nothing has changed. So Stephen is he's out of the loop at this point. He no longer has anything to do with this. The bank has $1,000, and they're happy. The daughter owes $1,000 that she doesn't have. Bob is owed $8,000 that he doesn't have. She's going to have to work, earn that money from somewhere else. Someone else outside is going to have to give her $1,000, and she's going to have to work at her job to get that in order to pay back Bob. The son also has promised to work for $1,000. He's going to earn that money in order to pay back his dad. Money has not been created. Debt has been created. A promise has been made that the son and the daughter are going to work, are going to each earn $1,000 that they will then give to their parents. The $1,000 has not changed. The money supply has not changed. In concept, the dad still owns $1,000 and Bob still owns $1,000. They don't have that because it has been converted into a promise. It's been converted into an IOU that someone is going to make money and pay them back. That's how loans work. And this is the same way with fractional reserve banking. The difference with fractional reserve banking is that they don't lend out the whole thing. It gets smaller and smaller and smaller. And you're adding a company in place of an individual. Another difference is that when an individual puts the money in the bank, they're not giving it to the bank saying, "Oh, here, do whatever you want with this." They are assuming the money's going to be there when they want to draw it out. So yes, the bank is taking a risk there. It's similar to an insurance company. When they lend out the money, they have to keep enough in reserve to pay back anyone that wants to take it out. And if they notice a lot of people are suddenly taking out their money, they're going to call a lot of those loans, people that owe them money, and say, "Hey, I need the money right now. And if you don't give me the money right now, I will take whatever asset you gave in security." So in this situation, if this was not a father and son, the dad, say it was somebody unrelated, they might say, "Okay, I'll lend you $1,000, but you have to put up your car as collateral, which means if you don't pay me back the $1,000, I take your car." So I still get something worth $1,000. That's how it works with the bank. With the daughter, we'll say she puts up a diamond ring or something. If you have a ring worth $1,000, what are you doing with your money? Seriously. Anyway, but yeah, I know there are rings worth multiple thousands of dollars, and I think it's a complete waste of money, but that's beside the point. But in any case, in the situations with the bank, it's actually safer than in situations with individuals because, again, there's collateral. So if the money doesn't come back, the bank still has something to back it up. They just take the collateral, sell that, and then they give the money to the individual. If there's a run on the bank where everybody wants their money right now, say within 2 or 3 days, then no, the banks aren't going to have enough money to pay it back. But if people start mistrusting the bank and over a period of time, say a couple of months, people are drawing out money more and more, the bank's going to be calling a lot of these debts and repossessing assets if the debts can't be paid, and they will be able to pay it back. Banks aren't just giving the money away. This gets into secured loans versus unsecured loans. Credit card companies are unsecured. So that's debt that is being created, which if you don't pay it back, there's nothing they can do other than take you to court and basically put a lien on future earnings, saying as you earn money, you have to pay us a certain percentage until you pay this off. But it's not like they can take your car. Again, unless they sue you for it. Whereas the bank, you basically hand over the title to your car or hand over the title to your house so that if you don't pay it back, they already own it. I tell that to, I talk about that with my house sometimes. I've paid off, I think 30% of my house. So people will say, "Oh, do you own your own house?" And I say, "I own 30% of it." And they look at me funny. I say, "Well, the bank owns the other 70%, but I'm buying it from them." And again, they just they look at me like, "What?" And I'm like, "You don't own your house. If you have a mortgage, you don't own your house. They own your house. Do you have the title? No, you don't. The bank has the title. And if you stop paying, they're going to keep the title. They're not giving it back to you." So yeah, I am in the process of buying my house from the bank. I mean, most people would say, "Oh yeah, you own your own house." And yeah, sometimes I'll just, if I don't want to get into it or whatever, or if it's somebody where I just don't even want to have a conversation, I'll say, "Yeah, I own my own house." And just because I understand what they mean by it. But technically, no, I don't. The bank owns it. Anyway. I'm getting a little, I may be getting a little complicated here, but hopefully that explains it a little bit. Oh, and I didn't do the assets and liabilities. But I mean, that kind of explains it a little bit. Does anyone want me to go into what a balance sheet is, assets, liabilities, and equity? Because I'm happy to do that. It's something that fascinates me, but I don't know if it would completely bore the chat. So let me, hang on, I want to look over the chat again, see how we're coming. Okay. Silly sailor, I misunderstood what you said. It says, yeah, if AA put the money under his bed, then V would go down, and I thought he was going to make a gypsy joke, but that's not what he meant. Okay, he meant velocity. Anyway. Okay. Yeah, McCarthy. Uh, so yeah. Um, oh, Stephen. Yeah, Stephen's a photographer. If anybody needs needs work in that. Okay. Let's see. Original portion. The argument I always heard was that if the bank has $1,000 deposited, they could lend 9,000 because everything's digital. No cash had to be printed. Yes, that is what so many people have been told. I can't. My last boyfriend, we would have so many arguments about money, not how you should spend it and how you shouldn't, but I mean what it is and what you're supposed to do with it. And he would say that the same thing. He's like, no, if you deposit $1,000, the bank can lend out 9,000. I'm like, no, they can't. No, they can't. And he would say that, oh, because it's all digital. I said, no, because the bank has to actually write a check. If you take out a loan, say you go to the bank tomorrow and you take out a loan for $1,000, they will literally write you a check for $1,000, which you can turn around and cash. They're not going to say, here, I'm going to digitally put $1,000 in your bank account and you cannot take it out. If it was all digital, you couldn't take it out. But you can. You can go to the bank and you can withdraw everything in cash. That cash has to exist somewhere. Now, again, it does not all exist in the bank because they're lending it out, because the money moves from bank to bank. And yes, in general, I would say that with regard to banks, most of it is digital in that I think the Federal Reserve probably has the cash, so that the banks don't actually keep the cash on hand. They have it, they store their cash with the, like, maybe not the Federal Reserve, but with some, I don't know how it works exactly, but they don't store all the cash there. It's more like they have ownership of the cash, but they don't have more than what is actually deposited. The banks cannot lend out more than what they actually have. Now they can send off whoever keeps their cash. They can say, hey, we're running low in cash. Send us over another $1 million in cash. And so, yes, here you go. Here's your cash. And then, that's deducted from the digital amount you have stored with us, whatever. Banks cannot change the money supply. The Federal Reserve can change the money supply. The Federal Reserve, I mean, they're not technically a bank. They're not even getting into the Federal Reserve. But yeah. So yes, the misconception of, oh, banks can lend out more than what they have because it's digital. No, banks can't. So anyway, cash supply, not money supply. Fractional reserve banking actually decreases cash supply. No, I don't think it does. I mean, it doesn't change the cash supply. Just think about it. Look at this example. This is an example. This is very, very similar to fractional reserve banking, except that there is no fraction involved. And in this case, it's not digital. It is cash. It's 100% cash. He has $100 bills that he hands to his son. He sends those $100 bills to Bob. Bob hands that cash to his daughter. Daughter hands the cash to Stephen, and Stephen takes the cash to the bank. That's the way it works. Now, granted, when you're working with banks, yes, it is often digital, but again, the banks don't have the power to alter the digital supply. Federal Reserve does. Banks do not. So, oh, Chris says go for it, but I don't know what I was. That was probably when I said I can go into balance sheets. Okay. Autistic Liz. Yes. I didn't know what autism was until I became an adult. I was homeschooled, and my parents were of the opinion that if somebody couldn't sit still or couldn't relate well to others or couldn't function as well as other people, it was just a lack of training, and they just died. And I had problems relating to people. I had problems understanding nuance. Even when I was a kid, I used to tell people, do not use sarcasm with me. Because I would get very offended when people would be sarcastic with me because I couldn't understand it. And I thought it was a problem with my ears. I honestly thought I'm tone deaf to people because I knew that other people could hear it. That when I'd say, how do you know they're being sarcastic? They're like, can't you hear it? And I'm like, no, I don't hear it. It just sounds the same. So I might sound crazy, but yes, I really, and I found out I am actually slightly tone deaf when it comes to music, not badly, but a little bit. And I always thought, okay, it's just a problem in my ears. I can't hear it when people are being sarcastic. And it wasn't until I was an adult that I heard about autism. And I'm like, no, okay. I think I might actually have a problem with, mentally as far as understanding when people are talking to me when they're being sarcastic and not. And I have gotten better. But yes, if people call me autistic, that's not an insult to me because I think, yeah, I probably am. I just don't know it. because again, my parents didn't believe in autism when I was young. They thought, nah, you're just making excuses for a kid that just doesn't know how to behave. So that's what I believed. I don't believe it anymore, but yeah. Okay. Everyone is wrong. Yeah. Everybody's wrong about something. That's one thing to remember. Nobody is right about everything. It's just, and I think most people, if they knew where they were wrong, they'd change it. Not everybody. Some people don't care. They'll still defend something even when they think it's wrong. But, oh, don't forget to thumbs up the stream. That's in the chat so I can say it. Thank you, McCarthy's List. Treasury Stores, hard currency. Yeah. Just asking where the myth comes from. Oh, McCarthy's, the myth of the $9,000 comes from what I explained there, similar to this situation. Again, just add bank in a couple of these places along the way, and people will say, oh, you're creating money because dad still owns 1,000, Bob owns 1,000, the bank owns 1,000. So look, you started with 1,000 and you created, now we have 3,000. So you started with 1,000 and created 2,000 out of thin air. That's where they get the idea that you just have one single deposit that then grows into all this money. They're not taking into account that, no, there's debt along the way. There's the promise of future earnings along the way. And it's really people who don't understand numbers. And I think I was born understanding numbers. I have always been so good with numbers and with logic. I'm so bad with people and relating relationships, that sort of thing. I'm so good with numbers. So, I mean, if you've seen the movie Unbreakable, where the whole concept of it is you have the people, you have these individuals who are so sickly, their bones are just so brittle, they'll break at the slightest touch. So therefore, there must be the opposite end of the spectrum, the people who are so strong, they just can't be injured. And it's a cute concept in theory. Anyway, I've always felt like that you have people who are good with numbers and good with people, then you have people who are great with numbers and bad with people, and you have people who are great with people and bad with numbers. I'm definitely the great with numbers. Anyway, so this is something that always made sense to me, and I couldn't understand why people couldn't get it. But having dealt with a lot of people who just don't understand numbers, who don't understand the concept of assets and liabilities, of debt, as well as, loans or whatever. Well, I guess loans are debt. As the increase in supply and the corresponding decrease in supply that equals out to a net change of zero. A lot of people just don't understand it. All they see is, oh, in the beginning we had one person with 1,000. Now we have 3 people with 1,000. Therefore, we've increased the money supply. And the truth is, no, this is the only 1,000 that exists. This exists as a promise that she's going to pay it back. This exists now as a promise that he's going to pay it back. And if you replace these two with banks, Dad does not have $1,000. He has a promise from the bank that the bank will give him $1,000 if he asks for it. Bob has a promise from the bank. Again, we're just replacing these two with banks, that the bank will give him $1,000 if he asks it. Again, this is, even if this is bank accounts where he put the money in the bank and the bank lent it out, he put the money in the bank lent it out, and he spent it. In this case, this end person is still the only one that actually has money. These two have promises from people that they gave the money to that the money will be returned to them. But this is the only one that actually has money. I'm sorry, my mic is in the way. Excuse me. Okay. Ever seen the across-the-board debt cancellation? No. But yeah, when people talk about, oh, the banks should just cancel the debts, or they shouldn't take away the house. If this was a bank, that it wouldn't be your car or a diamond ring, it's your house. And so many people say, oh, these banks are evil. They're taking away people's homes. And I just want to say, guys, you don't understand. The banks don't own that money. The banks are it's somebody else's money. It's Dad's money that he put in the bank. The bank has to get that money back. The bank can't just say, okay, that's fine, you don't have to pay back the money. If they say that, they're robbing their investors. Or I'm sorry, their depositors, not investors. A company would be investors, a bank would be depositors. So the idea, or like student loans, oh, we should just not have to pay them back. It's like somebody paid that money to the bank for the bank to be able to give you that money. You're not robbing the bank when you don't pay back your loans. You're robbing the depositor. Now, granted, there are some loans or some lending companies that are essentially loan sharks. And I've seen this. I've been doing bookkeeping for a long time. And I was doing doing the books for one company. They just called me in to help clean up their books. And they had a loan on, excuse me, a loan on the books and I said, well, what's the interest rate? Because they didn't have an amortization schedule. And I needed to put it in because the interest is an expense. I'm like, I don't know what the interest rate is. So how can you not know the interest rate? So I said, well, what paperwork do you have on it? And they're like, oh, we don't really have paperwork. We just have this one little thing. And I'm like, what in the world? And I finally looked over everything they had and I realized you're dealing with a loan shark. I said, do you realize they're charging you 50% interest? And I'm not exaggerating. They were literally charging 50% interest. And the guy looked at it and said, oh, really? I said, yes. Yes, you know, and this is people that don't understand money. I said, you're dealing with a crook. I said, this is not legal, what they're doing. Oh, I didn't know. So, yeah, you have things like that. But that's, for one thing, that's the rare exception. For another, it's not legal. Banks do make money. And yes, when they're lending a lot out at a comparatively high interest rate, if they're lending it out at 10% and only giving the individuals either 0% or 1% on their deposits, excuse me, which by the way, fractional reserve actually cuts into their profits, which I understand the concept behind fractional reserve, but if they were able to lend everything out, then of course they get more returns. But yeah, they definitely need to keep some in reserve. But I think most banks, well, anyway, sorry, I'm about to get off on a tangent of regulation, and let's not go there right now. All that to say, yes, some banks do charge higher interest, do have more aggressive lending practices, things like that, to where they're making a lot of money. A lot of banks make a lot of money. So I do understand that people are saying, oh, well, the banks they're earning too much and they're ripping people off. It's like, well, no, most people, again, if you're not dealing with a loan shark, most people know what they're getting into when they go into it. They sign the paperwork seeing I'm going to be paying it back with this much interest. If I don't pay it back, I'm going to face these fees and these fines and whatever and all of that. Or if if I'm late with the payments, I'm going to have these fines. If I just don't pay it off at all, I'm going to lose my house or my car or my wedding ring or whatever it is, whatever the collateral is. So most people do know what they're getting into ahead of time. And if they don't pay it back, that's not the bank's fault. And you can't say, oh, this evil bank, they're taking someone's home. That person already sold their home to the bank and they're buying it back. They stopped making payments, so now they don't get the house. When you take out a loan on your car, you literally give them the title to the car. You have a surrendered ownership of your car. The bank now owns your car and you are buying it back. And if you stop making payments, you don't get to keep the car. It's the same as if you go to an auto, what do you call it? A car lot. Couldn't think what they're called. You go to a car lot and you say, okay, I want to buy this new Mercedes-Benz, and say, all right, well, you're going to pay this much per month for this many months. If you stop paying, they're going to take the car back. It's like, I'm sorry, you don't own the car. You haven't finished paying for it. That's the way it works. So anyway, so on the concept of debt cancellation, that's how we got off on that. Oh, yeah. People go, it says, happens all the time here. I don't know where you are actually in the car, too, where I don't know what you mean when you say debt cancellation happens all the time here. They go through the books and wipe out what the bank owes. Yeah. See, that's a bad thing. Okay. Banks don't increase or decrease money supply. They transform it. They do technically decrease the amount of cash in circulation if you count for the amount of cash they need to hold in reserve. Yeah, that's true. That's why the definition of money supply includes cash held on deposit. Yeah, money supply, if you're talking about, again, it sounds, when people say they increase the money supply, again, they're talking about gross versus net. And here, I'll go into that briefly. This was supposed to be kind of a short stream, but all right, we are going to get into a little bit of bookkeeping here. I'm going to show you, if you own a business or you start a business or whatever, there are two reports that you want to understand very well. There are a lot of reports you may want to look at. I mean, you're going to want to look at AR and AP and forecasts and budgets and all of that. But two main reports that everybody has to understand if you are, and I don't want to use abbreviations, if you're running a business, is your profit and loss on your balance sheet. just going to talk about profit and loss for a minute. You run a business. You make sales in the first year of $100,000. That is your gross receipts. And this is what, when talking about fractional reserve banking and all of that, a lot of people are going to say this is the actual money supply. This is not the profit for the business. This is how much money you brought in. Now, from that, we have to take out supplies, also called cost of goods sold or whatever. We had to pay $50,000 in supplies for the business. We also had travel expenses going to, to locations to deliver products, whatever, travel expenses anyway. We'll just say, $5,000. So not a lot of travel. Also had payroll because we hired some staff. $15,000. That was payroll. So at the end of the first year, business owner, what's that, 2070? So business owner made $30,000. This is the profit. It's also called the bottom line. It's called a lot of different stuff, whatever. So at the end of the year, business owner says, how much money did I make? People who don't understand money, they're just going to look at the gross receipts and say, oh, wow, look at that. We had $100,000 in sales. That's awesome. People who understand bookkeeping are going to say, no, you made $30,000, which is still a lot of money. That's nice. But if you need to live and support a family or something off of the business, then $30,000, well, $30,000 still seems like a lot until you realize, oh, I'm self-employed. I have to pay twice as much taxes as everybody else. So while other people are losing about a quarter of their income, if they were that, I'm losing more like, well, I'm trying to think, I'm losing 15% on Social Security, Medicare, and then another 10 to 20% on tax. Anyway, losing a lot of money off of that. We won't get into taxes too much. I'm self-employed, so this is an issue that I have to think about a lot. It's rather frustrating. So like if my business made a profit of $30,000 at the end of the year, no, I only got maybe $15,000 to $20,000. I don't actually, after taxes, I don't get $30,000. Well, if it was that low, I'd probably get, 20, 23. Anyway, I'd have to look at it. But this is something you need to take into account. This is similar to what we were talking about before. When you say, oh, it increases the actual money in circulation, this is the money in circulation. That's the actual money that changed hands. But all of this money changed hands also, going back out. So that's the end number. That's not the number you want to look at. That's the number you want to look at. Now, here we go. So that's one report you need to understand if you have a business. The other report is the balance sheet. This is something, again, sorry about the lighting. If I can't really, okay. That's the overhead light. The one over here is just that's a lamp. But anyway, I lose my train of thought too easily. The balance sheet tells your assets and liabilities. So the balance sheet is going to say something like, okay, well, I have a bank account. So at the end of the year, so this is what it looked like. This is what my activity looked like. And at the end of the year, in my bank account, I have $10,000. I also have, I have equipment, for whatever business I use, either computers or tables or cameras or cars or whatever. Whatever the equipment is, I have equipment of $5,000. Now, okay, we're gonna put this as an. There's two different ways of doing it. There's cash and there's accrual. If you're a small business, you're going to be running it on cash, not accrual. But I think this is going to hopefully make sense to some people. I'm going to do this on accrual for. If those words don't mean anything to you, just forget about them. We also have, okay, my handwriting is terrible. Yeah. Receivables, this is what your clients owe you. So people owe us our business $1,000 that we've done services or sold them things and they just haven't paid us yet. So we have net assets here of 16,000. This would be the money supply, if you will, that some people are saying when it's talking about the fractional reserve there, you know, that dad has 1,000, Bob has 1,000, the bank has 1,000. So total net assets there are $3,000. What you have to take into account here are the liabilities and the equities. We have payables, which are the same as, say, bills. So we have bills that we owe to other companies where we bought something and just haven't finished paying it back or whatever. We have bills of, I'm going to just say 500. If possible, keep your payables less than your receivables. Doesn't always happen. I mean, they kind of vary, but if we're going to say that this is a good company, hey, they turned a profit, so they're doing something right. We also have a loan, because in the equipment there, we actually will say, well, some of the equipment was purchased with a loan, and we still owe $2,500 on that loan. Okay. We have the, oh, hold on, I just messed. This is not actually going to work. Oh, yes, it is. Sorry. Okay. Net income for the year, which is actually that this is getting a little complicated. This is a liability. This is a liability. This is equity. So equity and liability are different, but anyway, you'll have the equity down here, and then you have the owner draw, which is just how much money has the owner taken out over the course of the year. And in this case, they took out, is that going to be 17? See if that adds up. 13. Got too many numbers in my head because they go back and forth. Actually, I think I've got that backwards. And then, yeah, okay, forget. I'm going to take out the net income. That's, I'm used to doing this on. I'm not used to doing this like this. I'm used to doing it on the computer. So I mean, yeah, owner draw is going to have to be actually a lot more than that. But anyway, here I'm just going to take out net income because that's going to be, and here. Basically, all the equity will be combined into one line. Owner equity is how much of the business the owner actually owns. So in this case, we have debt. Of the owner equity is, in this case, is going to be, yeah, 13,000. Okay, which is basically what this is saying is that while the assets total 16,000, what the owner actually owns is only 13,000 because they have $3,000 in debt. So what is the net worth of the company? It's not the 16,000. You have to subtract out the debt. You say it's only worth 13,000. Now, again, we're kind of messing things up because if you understand bookkeeping, you know, I'm not giving the full picture here. I'm trying to simplify it so it's not too confusing, and hopefully I haven't lost everybody at this point. Anyway, but yeah, if you have a business, understand there are a couple more lines in here that, yeah, feel free to leave a comment below. I can try to explain it better or give you pictures of actual balance sheets. Man, I feel like I'm teaching an accounting class here. Oh, and I just realized some of these numbers probably aren't coming through very well. But yeah, so you can see there. I hope I haven't lost everybody. But hopefully this makes sense somewhat. As a business, if you're looking at your income, you don't look at just the sales to say, how well have we done? You have to take into account the expenses. So you look at the net numbers. You look at what's the final number. You're looking at the balance sheet. If you just look at the assets and say, oh, wow, look at that. We have $10,000 in the bank. We have equipment worth $5,000 and we have people owe us $1,000. Look at that. We have $16,000. No, you don't, because you owe $500 for various bills. You owe $2,500 to the bank, and maybe also oftentimes you'll have like a credit card or whatever. But basically, what is the business actually worth? No, it's only worth 13,000. So yeah, I'll take off owner. Oh, sorry about that. I'm going to take off owner equity. I'm just going to say equity because that would. What that's actually called is going to vary depending on what the business type is. My business is an LLC partnership, so it would have partner equity. It used to be a sole proprietor when I first started, so it was owner equity. If I incorporate and it becomes an S corp, then it's going to be shareholder equity, and then yeah. Anyway, so I'm just going to put equity. All right. Again, hopefully I haven't lost everybody. Hopefully it's not too boring and dry. But let me just going to glance back at the chat again. Yeah. Thank you, Cave or Cave. I'm not sure how you pronounce that. It looks like cave. Rhymes with rave, I guess. Anyway, silly sailor, self-employed people pay more in taxes than employees. It's the opposite in the UK? Oh, wow. That's nice. Yes, in the US, you pay the Social Security and Medicare is combined together is, what is it, 7.65% of income, 6.2% Social Security, 1.45% is Medicare. So everybody has to pay 7.65. So just over 7.5% of their income goes to the government. In addition, employers have to pay the same amount. They have to pay 7.5%, again, just over 7.5% for to basically match what their employees pay. So that's just Social Security, Medicare. That's before income tax. If you're self-employed, you have to pay both portions, both the employee portion and the employer portion. So before income tax comes out at all, you have to pay just over 15% in just Social Security, Medicare taxes. So anyway, yeah, what do you do for a living? I own a bookkeeping business. What I do is I do small business bookkeeping. So small businesses that want somebody to do their bookkeeping. Oftentimes entrepreneurs, sometimes actual fair-sized businesses or whatever that just need somebody to keep their books. That's what I do. I don't, if they don't want a lot of businesses, they are large enough that they need somebody outside to do they need a professional to do their books, but small enough that they don't want to hire a full-time professional, and frugal enough that they don't want to hire a CPA or a CPA firm, because a CPA firm will charge like at least twice, up to 4 or 5 times as much as I'll charge. So they'll hire my business, and I do the bookkeeping. So yeah, rightful king of Finland. I've never done it for an international company, but it would be interesting if I ever got I've gotten businesses all over the U.S., small businesses. Well, I say that, no, more like all over the East Coast. But I haven't gotten any out west yet. So, okay, hopefully that's answered some questions. Did go on longer than I expected, and I'm hoping I haven't completely lost anybody. And I hope that I've cleared up some misunderstandings about fractional reserve banking. And I really think it's just people, they don't understand how it works. They don't understand the concept of assets and liabilities. So all they look at is a huge increase in the assets. Because basically here, let's say that this business decided they want their books to look better. I had this happen. Oh, I was so frustrated. One of my clients decided they were going to sell the business. So they literally took out a loan. So we have loan one, I can spell. I have a touch of dyslexia, so I'll sometimes write letters backwards. Oops, I do know how to spell. I'm not actually dyslexic. It's just a little bit. Anyway, so they took out a second loan. And I'm making up numbers here. This is not what they did, but it was similar to this. Took out a second loan of $50,000. Technically, what they did is they just stopped paying on their credit card. They just let that balance build up, so it was huge. And so their bank account looked really big. So then they were looking at this and they said, "Oh, look, we have net assets." Or I'm sorry, they said, "We have assets of $76,000." And I said, "Yeah, but you've got a liability there of $50,000. You haven't changed your net worth. Your net worth is the same. In fact, it's going to look a little worse now because you're going to have to pay that $50,000 back with interest." And they're like, but no, look, our assets are more, so our business is worth more. I said, "No, it's not. No, it's not. You owe that much money that you haven't changed anything. You've just made yourself worse off because you've now incurred a future debt because you're going to have to pay this back with interest." I mean, essentially, it's increasing your bills, even though we haven't. If we were to take that into account. Now we're going to have to add another $5,000 to your bills because you're going to have to pay that interest back unless you pay it back now. I mean, we don't actually do that with loans, but he just couldn't get it. This was, some people don't understand money, which is why I have a job. Because they're just like, I don't know how to do this. Here, can you do it? And I'll pay you to do it. I said, sure. That is not a problem. Here's how much I'm going to charge you. It's kind of like the loans. You're going to pay this back, and this is how much money you're going to pay back in addition. So yeah, when people look at the fractional reserve banking, they're just looking at this. They say, oh, look, there's more money now. They increased the money supply. It's like, well, no, that money came from somewhere, and with that increase in money is the promise that it's going to be paid back, either with this money or they're going to earn more money and use that to pay it back. If this is what your balance sheet looks like, I mean, it's not too bad. However, if this is what your balance sheet looks like, in this case, it's going to be a negative, wrong color. Anyway, if this is what your balance sheet looks like, where your equity is negative and your net income for the year is less than the absolute value of your negative equity, you got a problem. You got a real problem. Your business, then you need more than a bookkeeper. You need a budget. You need a very strong budget. But anyway, okay, I'm getting off topic again. I can go off on rants on bookkeeping. People that don't understand bookkeeping. Oh, that would change that also. Anyway, as I said, hopefully that makes sense to people. This is a bad balance sheet. If this is what your balance sheet looks like, you got problems. If this is what your income sheet looks like, that's good, as long as this is not what your balance sheet looks like. Anyway, again, if you have questions, whatever, feel free to comment, or you hit me up on Twitter too. At Based Elizabeth. I spell Elizabeth with an S. I should put the link. I don't think I put the links in my videos. I need to do that. But anyway, if you want to engage in conversation, you can do that also. Hopefully this has helped some people, help clear up some misunderstandings. And so I'm going to end the stream now. I hope you all have a great day. Thanks.